Trading is not about predicting the next candle. It's really about reading the footprints left behind by institutional algorithms. You see, it's a methodical, rule-based observation of price delivery. The interbank price delivery algorithm, or IPDA as we call it, is completely indifferent to your trend lines. It does not care about your retail indicators. Its sole programmed purpose is to seek liquidity and rebalance inefficiencies in the market. If you don't understand exactly where the algorithm is drawing price to fulfill these very specific objectives, you aren't trading alongside the institutions. You're actually just providing the liquidity for those who do.
90% of traders this week will enter positions right in the middle of liquidity zone, and that is exactly why they will continue getting stopped out. If you are only looking at retail trend direction without knowing precisely where smart money is hunting liquidity to pair their massive orders, there's a very high probability you are trading directly against institutional flow. In today's explainer, I'll break down the entire market structure through the ICT lens.
Section 1. Institutional Market Context.
Before we even think about opening a chart to look at candlesticks, we have to establish the macroeconomic narrative. What is institutional money actually doing behind the scenes? Are they in a heavy accumulation phase, or are they distributing? Understanding this macro flow is the absolute prerequisite for literally any high-probability ICT setup. Take a close look at this one-week performance heat map. The broader market is screaming a very clear risk-on sentiment. We can see the VIX, the volatility index, has dropped by a pretty significant 8.47%. And right alongside that, global equities are surging. We've got the Nikkei leading the charge with a massive 7.02% rally. But here is exactly where the smart money footprint becomes highly visible to the trained eye. Look at the US dollar. Now, despite the broader risk-on environment, which as you know, usually pressures safe haven currencies, the dollar is actually up 1.13%. It is dominating across the board. So why is that happening? It's because institutional order flow is actively pricing in sustained US economic strength, heavily driven by explosive core retail sales data. Smart money is aggressively accumulating the USD. At the exact same time, they are heavily distributing commodities and commodity-backed currencies like the CAD and NZD, which is being fueled by a near 9% collapse in crude oil. This divergence right here sets our fundamental bias. And why does this matter to an ICT trader? Because if we don't understand the macro draw on liquidity, our lower time frame order blocks are completely useless. They're just lines on a chart. We are specifically looking for setups that pair a strong USD against the absolute weakest links in the market.
Section 2. ICT Analysis, NZDUSD.
This brings us to our first deep dive technical analysis, the New Zealand dollar against the US dollar. Right now, this pair presents one of the clearest macro imbalances in the entire market, but executing it requires absolute patience and strict top-down alignment. Let's methodically break down the institutional framework. Starting from the higher time frame on the weekly chart, the overarching market structure is undeniably bearish. Notice the failed swing highs established right around that 0.6100 level. Retail breakout traders saw that high being breached, and what did they do? They immediately bought the breakout. Smart money engineered that exact run on buy-side liquidity only to heavily distribute their short positions straight into those willing buyers. This was immediately followed by a decisive break of structure, a BOS, to the downside.
Dropping down into the H4 chart, we can start to identify the specific points of origin for this massive bearish expansion. During that violent sell-off, price left behind a massive, unmitigated bearish order block right at the 0.5840 level. But even more importantly, look at the gaping fair value gap, the FGV, extending from 0.5800 all the way up to 0.5850. From a pure algorithmic standpoint, this rapid displacement meant only one side of the market was offered, the sell side. It created a severe inefficiency in price delivery, and the interbank price delivery algorithm, it absolutely abhors these vacuums. It has a very high mathematical probability of drawing price back up into this exact zone to rebalance the inefficiency. It needs to offer the buy side of the market before any further macro expansion to the downside can safely occur. These are the exact structural footprints we look for.
Now, analyzing the H1 chart, we can observe precisely how liquidity is being engineered on the intraday level. This aggressive downward expansion has already aggressively swept the external sell-side liquidity. Essentially, the market has done its job on the downside for now. Because that sell-side liquidity is entirely exhausted, smart money now requires new liquidity to fuel the next leg down. So ask yourself, where is it? It's the engineered internal buy-side liquidity resting directly above these short-term lower highs. Retail traders see this minor upward movement as a brand new reversal uptrend. The algorithm, however, sees these resting buy stops as a magnetic draw. It's going to hunt that liquidity to mitigate its short positions at a vastly better price before finally dropping further.
This brings us to perhaps the most critical rule of ICT, dealing ranges, and pricing arrays. Look at where we are. The current price is sitting all the way down at 0.5736. We are deep in a discount array. As a professional, you must absolutely resist the fear of missing out. Do not FOMO sell down here at a discount simply because the momentum looks heavy. Smart money does not sell at cheap prices, they sell at a premium. Our discipline dictates that we must wait for a retracement. We let the amateur retail traders sell the absolute bottom, let them provide the liquidity, and we patiently wait for price to be drawn back up into our 0.5835 premium zone, right back up into that H4 order block and FEG. Furthermore, I want to note that we are not forcing any SMT divergence analysis here. Correlated instruments, like the Aussie dollar, do not currently display clear divergence, so we simply state that fact and trade what the chart clearly provides. We never force technicals that aren't actually there.
Section 3. ICT Analysis, USDCHF.
Let's pivot to our second asset, the US dollar against the Swiss franc. This chart presents the exact mirror opposite setup to the Kiwi we just looked at, yet it requires the exact same institutional discipline and logic to execute correctly. On the weekly chart, we are witnessing a textbook macro shift. After a very prolonged bearish trend, the market printed a clear change of character, or CHACH, shifting the underlying structure entirely from bearish to bullish. Smart money actually spent considerable time building an accumulation base down at the 0.7650 level. They repeatedly swept old lows just to absorb sell-side liquidity. Every single time retail traders shorted the breakdown, institutions were right there on the other side, pairing those sell orders with their massive buy orders to quietly initiate this new upward campaign.
Zooming into the H4 chart, the bullish expansion is steep, deliberate, and highly aggressive. We have a continuous sequence of higher highs and higher lows, with multiple breaks of structure firmly confirming the institutional sponsorship. They are actively defending their long positions at every single dip. Crucially, this expansion originated from a high-probability, unmitigated bullish order block resting right between 0.7910 and 0.7940. And just like our previous example, the rapid upward displacement left behind a significant fair value gap that remains entirely unfilled. This is our institutional footprint. It is the designated area where the algorithm will undoubtedly look to reprice.
Looking at the current price action on the H1 chart, we see the market is beginning to stall at the highs. This is simply mathematical exhaustion after a major expansion. Do not confuse this with a macro reversal. It isn't one. What is the algorithm actually doing right now? It's preparing for a market retracement. Smart money will likely target the internal sell-side liquidity resting right below these short-term H1 lows, specifically below the 0.7970 level. They literally need to trigger those retail trailing stop losses to reaccumulate long positions at better pricing. By knocking retail out of the trade, they secure the exact liquidity necessary to initiate the next macro leg higher.
Once again, we apply our strict premium and discount logic to the current dealing range. The current price is hovering way up around 0.8065. We are trading in a deep premium zone relative to the institutional dealing range. Amateur traders see those strong green candles and they just FOMO buy right at the absolute peak. A professional ICT trader does the exact opposite. We wait, we absolutely require the algorithmic retracement to bring price back down into our 0.7940 discount zone. By patiently waiting for price to drop, re-enter that bullish FVG, and tap the order block, we align our entries precisely with where smart money is mathematically programmed to look for accumulation.
Section 4. Forward Guidance and Scenarios. Listen, all this theory is completely useless without practical application. We do not react emotionally to moving candles. We execute methodically based on predefined algorithmic scenarios. Here is the ideal sequence we require for execution this week. First, we wait for a deliberate sweep of liquidity. That's buy side for a short scenario or sell side for a long scenario. We absolutely need to see that retail trap set. Second, we look for displacement. We want to see a highly energetic, high-volume move away from that sweep that causes a clear market structure shift. Third, we exercise immense patience and wait for the mitigation. Price must return to our identified order blocks and fair value gaps. Only then do we execute the entry. We immediately set our risk parameters and we target the opposing external liquidity pools for our take profit. This is the sequence: sweep, displacement, mitigation, target. Do not skip a single step. But what if the market simply doesn't provide this perfect sequence? Well, that brings us to scenario 3, the no trade scenario. I'll be honest with you, this is arguably the most important scenario for a professional trader to master. If price fails to sweep liquidity, or if it meanders aimlessly without clear displacement, or if it completely disrespects our premium and discount arrays, we do nothing. We strictly protect our capital. Sitting on your hands is an active, highly profitable trading decision. In this business, capital preservation is paramount. If the algorithm isn't crystal clear, we simply wait until it is.
Section 5. The ICT Trading Plan.
We must anchor our technical analysis in time and risk management. In the algorithm, time is just as important as price. Reviewing the economic calendar is absolutely non-negotiable before you even think about placing a trade. This week, we have some severe, high-impact data coming up. On Monday, we have volatile Canadian CPI data, which will heavily impact oil and CAD crosses. Then on Thursday, we face the US Core PCE Price Index and final GDP. These are Tier 1 liquidity injections. As an ICT trader, you must be flat or have your stops tightly protected at break-even during these major data releases. We do not gamble on the fundamental outcome of the news. Instead, we wait for the news to create the volatility, to sweep the liquidity, and then we trade the algorithmic aftermath once the dust finally settles.
Our rules of engagement for the week are strictly defined. The highest probability trading days will always be Tuesday, Wednesday, and Thursday. Mondays are often just for establishing the weekly initial range, and Fridays carry completely unnecessary weekend risk. We prioritize the daily and H4 charts strictly for our macro bias and identifying the institutional draw on liquidity. We then drop down to the H1 and M15 charts exclusively for timing our execution. Most importantly, we isolate our execution entirely to the London and New York kill zones. This is when institutional volume is at its absolute highest and the algorithm is actively seeking liquidity. We do not force trades in the dead, meandering volume of the late Asian session.
Section 6. Trader Mistakes and Psychology.
To truly master this methodology, we have to ground our technical theory in trading psychology. The entire premise of smart money concepts relies on understanding and exploiting the retail mindset. Let's methodically break down the 5 most common pitfalls that completely destroy developing ICT traders. Number 1, entering a trade before liquidity has actually been swept. If you enter too early, you are literally just becoming the liquidity for someone else. Number 2, FOMO buying or selling breakouts instead of patiently waiting for the algorithmic retracement to a discount or premium array. Number 3, ignoring the market structure shift. Without a clear structural shift, you are just blindly trying to catch a falling knife. Number 4, entering blindly in the exact middle of a fair value gap without waiting for a lower time frame reaction. And number 5, failing to wait for the final mitigation of the order block. Impatience is without a doubt the retail trader's most expensive tax.
Let's consider an exact scenario that plays out on the charts practically every single day. A retail trader sees a minor break of structure to the upside. Driven entirely by the fear of missing the move, they immediately hit the buy button, placing their stop loss just below the recent swing low, exactly like some retail textbook tells them to do. Shortly afterward, the market drops sharply, squeaking that exact sell-side liquidity. The retail trader gets stopped out, taking a painful, frustrating loss. And then, almost magically, price aggressively reverses and moves massive distances in the original bullish direction they predicted. Why did this happen? Because the retail trader's impatience provided the exact liquidity smart money needed. Institutions absolutely required those sell stops to pair with their massive buy orders. The algorithm engineered the trap, mitigated its positions, and then expanded. Once you understand this from an ICT perspective, you stop trading the breakout and you start trading the sweep.
Trading these highly precise institutional levels requires absolute precision from your broker as well. If you found the insights in this explainer valuable, make sure to like and subscribe. Furthermore, if you are looking to execute these tight ICT scalping and intraday strategies, you absolutely require low spreads and lightning-fast execution so you aren't slipped during these violent algorithmic expansions. Consider opening an account with FXTM through the link in the description to ensure your broker infrastructure matches the exact precision of your analysis. I'll leave you with this final thought as you prepare your charts for the trading week ahead. When you log in tomorrow morning and look at the nearest highs and lows, ask yourself honestly, are you patiently waiting to hunt the liquidity, or are you about to become the liquidity being hunted? Stay disciplined and trade the institutional footprint.